Managerial accounting. Let's go back to your hospital. Patients are coming in, doctors are working, the pharmacy is active. Everything looks successful from the outside. By the end of the month, you sit down with your accountant and the report says, "We are not financially stable." Now, this becomes confusing. How can we be busy but not making progress? That moment is where managerial accounting begins. What is managerial accounting? Managerial accounting is the process of identifying, measuring, analyzing, and interpreting financial information to assist managers in planning, controlling, and decision making. It is not just about keeping records, it is about using financial information to guide actions. It helps managers understand what is happening financially within the hospital and, more importantly, what needs to be done to improve performance. This means it supports planning future activities, controlling current operations, and making informed decisions. So instead of simply asking what happened, managerial accounting asks, what should we do next? Example: a hospital may have many patients but still struggle financially. Managerial accounting helps uncover whether the issue is high cost, poor pricing, or inefficient resource use. To make good decisions, you must first understand how costs behave. Cost behavior. Cost behavior refers to how costs change in relation to the level of activity or volume of services provided. In a healthcare setting, the number of patients directly affects many costs. However, not all costs respond in the same way to changes in activity. Some costs remain constant, while others increase as more patients are treated. Understanding this difference allows managers to predict future expenses, plan budget accurately, and avoid financial surprises. Without this understanding, managers may assume that all costs behave the same way, leading to poor financial decisions. Now let's explore the different types of costs. Types of costs. Fixed costs. Fixed costs are costs that do not change with the level of output or number of patients in the short run. They remain constant regardless of how busy or quiet the hospital is. These costs must be paid even when there are no patients. It creates financial responsibility that the hospital must meet all the time. Because fixed costs do not reduce when activity is low, they put pressure on the hospital during periods of low patient turnout. Examples are salaries of permanent staff, rent and building maintenance, and equipment depreciation. Hospitals with high fixed costs must maintain consistent patient flow to remain financially stable. Variable costs. Variable costs are costs that change directly with the level of activity or number of patients. Variable costs increase as more patients are treated because more resources are used. When patient numbers decrease, these costs also reduce. This makes variable costs more flexible compared to fixed costs. However, if variable costs are too high, they can reduce profitability even when patient numbers are high. Examples: drugs and medications, laboratory consumables, medical supplies. More patients do not always mean profit if variable costs are not well controlled. Semi-variable costs. Semi-variable costs are costs that contain both fixed and variable components. These costs have two parts. One part remains constant while the other part changes with the level of activity. This makes them more complex to manage because they do not follow a simple pattern. Managers must understand both components to properly plan and control expenses. Examples: electricity. When you take electricity, the base charge plus the usage. We have maintenance cost as well. Failing to understand semi-variable cost can lead to underestimating expenses as activity increases. Now think about this. Your hospital is busy, but fixed costs are high. Variable costs are increasing. Semi-variable costs are rising. Now you understand why being busy does not always mean being profitable. Let's link this to decision making. At this stage, managerial accounting begins to guide our decisions. Managers start asking, should we expand services? Should we reduce cost? Should we adjust pricing? All these decisions depend on understanding cost behavior. Now let's move on to contribution. Contribution refers to the amount remaining after variable costs are deducted from revenue, which contributes to covering fixed costs and profits. When a patient pays for a service, that money does not go straight into profits. A portion of it is first used to cover the costs of treating that patient, which is the variable cost. What remains after removing the variable cost is what we call contribution. This contribution is then used to cover fixed costs and generate profits. So contribution is the bridge between revenue and profits. Example: if a patient pays 100 Ghana cedis and it costs 40 Ghana cedis to treat them, the remaining 60 Ghana cedis is the contribution. That 60 Ghana cedis will now help pay salaries, rent, and eventually contribute to profits. A service with low contribution may not be sustainable, even if it attracts many patients. Decision making using managerial accounting. Managerial accounting provides the information needed to make informed decisions. Managers do not rely on guesswork, they rely on financial data. Every major decision in a hospital involves cost analysis. 1. Expanding services. Before opening a new department, management must evaluate whether the expected revenue will be enough to cover both fixed and variable costs. If the contribution is not sufficient, the expansion may lead to losses. 2. Reducing costs. Managers may identify areas where costs are too high and implement strategies to reduce unnecessary expenses without affecting quality of care. 3. Pricing decisions. Cost information helps determine whether current prices are appropriate. If prices are too low, the hospital may struggle financially. If too high, patient demand may decrease. 4. Resource allocation. Managers must decide how to allocate limited resources across departments to achieve the outcome that is best. Now let's move on to importance of managerial accounting. 1. Cost control. Managerial accounting helps identify areas where costs are excessive. By controlling these costs, hospital can improve efficiency and reduce waste. 2. Decision making. It provides reliable financial data that support informed and strategic decisions. 3. Planning and budgeting. It enables hospital to plan future activities and allocate resources effectively through budgeting. 4. Performance evaluation. It allows managers to compare actual performance with expected outcomes and identify areas for improvement. 4. Profitability analysis. It helps determine whether the hospital or specific department are financially viable. Let's move on to challenges in managerial accounting. 1. Poor record keeping. Inaccurate or incomplete financial records make it difficult to track costs and make sound decisions. 2. Lack of skilled personnel. Without trained staff, financial data may not be properly analyzed or used effectively. 3. Delayed NHIS payments. Late reimbursements affect cash flow and disrupt hospital operations. 4. Rising cost of medical supplies. Increasing costs reduce profit margins and put pressure on pricing decisions. 5. Weak financial controls. Poor monitoring systems may lead to inefficiency, waste or misuse of funds. Ways to improve managerial accounting. 1. Implement digital systems. Using accounting software improve the accuracy and efficiency. 2. Staff training. Training staff enhances their ability to interpret and use financial data. 3. Regular monitoring. Continuous review of financial performance helps detect problems early. 4. Align pricing with cost. Ensuring prices reflect actual cost improves sustainability. This is Eric Podcast.